if you were to go to sell a property and say, hey, here's my property, here's all the expenses, and you don't list a property management expense, you are underestimating or understating your operating expenses. And you are therefore not painting a full picture of what it's going to cost to operate that property. Consequently, or conversely, if the buyer was to look at a property and say, hey, I'm going to self-manage this thing, so my operating expenses are not going to be as high, they might wind up overpaying for a property. You need to properly develop your operating expenses. One of the ways to properly develop them is to include like plug numbers or some value of services that you might be doing yourself, just to be sure that maybe you decide to stop managing it. Hey, Kristen.
Hey Morgan, how are you?
I'm good. How are you doing today?
I am doing fantastic. It's a great day today.
Yeah, for sure. We've been having a little bit of pre-show planning here, trying to get this thing off the ground. This is our third recording of this podcast, but it's the first time that I have had you be remote.
I know
So
you showed me the overview shot earlier and it just looked so sad
it's kind of
without
lonely.
like it looked
It's
empty.
Yeah, I have this like big studio. It's like waiting for four people to be in here, and it's just me. So I
Yeah.
don't know, but that's okay. That's okay. So, I was looking over our script and it
hmm
made me think of something that I was wondering if you were aware of. There's this, it's not a meme. I don't think it qualifies as a meme, but I've seen this little image about bionic reading. And it has to do with where you bold the first half of a word and you don't bold the second half of the word. And
hmm
you do you know about this?
Yes. Oh yeah. I've heard about it. I think I've seen that image that you're talking about floating around on the interwebs.
Okay, so here's the thing. Like the other day, you were reading something, maybe we had written something, and I was like, okay, let's read this real quick. And you read it twice as fast as me because, like, I just don't read that quickly. My wife, same way. She'll blow past something, and I'm like, whoa, hold on a second. But I read whatever the sentence was where it had the first half of the stuff bolded,
hmm
and I was able to fly.
Wow.
So I thought that was kind of interesting, but this is where things also get interesting. You are a huge note taker, yes?
hmm Yeah.
Have
Oh,
you?
absolutely. I have hundreds of notebooks, Morgan.
Wow, have you ever tried out those e-ink note taking tablet things?
So the reason that I bought the computer that I have, so it's called a Concept D easel. And so it has a stylus that comes with it and it has a screen that folds down so I can write on it as a notebook. And whenever you write on that in Word or Google Docs, they have a function where you can write and then it'll turn it into a document. So that was my whole reasoning behind buying the computer that I bought because I was looking at those different notepads to be able to do it, but I wanted something that would automatically upload to my cloud or to whatever drive I was using. And so that was I researched hard because I had a Surface, but it broke, which is the saddest day of my life. But
Oh,
then I bought this computer so I could write on it because I enjoy the
yeah.
task of writing.
Okay, yeah, and you've told me that before, and I know that writing can be a really good way of remembering things. We had a person in here for a meeting that had a tablet that was called a Remarkable tablet, and
hmm
it is a apparently they're marketing these things as dumb devices, so as opposed to having a smart device. So
Right.
its only job is for note taking or reading.
Yep.
And so I got to researching it last night and I discovered that on Kindle and some on other things, you can enable bionic reading. And so
Oh, really?
I want to grab a book that I've been meaning to read and turn on bionic reading. I have a Kindle, so I was going to try it on my Kindle, but
Mhm.
if I really enjoy it, I was thinking about getting one of these dumb devices and using it for reading Bionically and and the notes. So I just knew that you might. I knew on the notes that you were into that, but I wasn't sure if you were up to
Oh
speed on the
yeah.
Bionic thing. So
Yes, and I think that I'm a naturally I read pretty quickly. I don't know why I don't. It was a technique that I was taught in school where you would like look at a page for a second and go through and kind of scan for keywords or themes, and then you would go back through and then scan the text, which then understanding like where the page is going helps then to read faster because it's like I know where it's going to end up and I know these keywords in here, and then my brain is like filling in the in between places. I remember being taught that in school, and so that's how I've always read books or emails or things like that, which is great, but then I miss some of the smaller details because I'm keyed into certain parts of a page.
wow, that is amazing. No one ever taught me that. So and consequently, I am just not the fastest reader.
But
But
now you have bionic reading, so I think that you'll be
there you
okay.
go. There you go. I love it. I love it. All right. Well, on that note, maybe we should dive right on in here. Um, so, okay. So let me maybe set the stage here about what we're wanting to work on. So to give our listeners of this show a foundation to build upon, and to help all of us be on the same page, I want to do a series in the very beginning of this podcast here to go over some commonly used real estate metrics. I want to include cap rate, cash on cash, and internal rate of return, with today starting out with cap rate and including the concept of net operating income, which we call NOI, because without NOI, we cannot calculate cap rate.
That sounds very interesting of what we're going to be covering today. But I think that specifically with NOI, that's a term that I learned a little bit later on in my career. It definitely wasn't one that I picked up right away whenever I started in real estate. What, at a basic level, Morgan, is NOI or a net operating income? Why do we care about it? And most importantly, how do we calculate that bad boy?
Okay, good questions. Good questions. So NOI, or net operating income, and we'll probably just go with NOI from here on out, is how much money the property generates before it pays the loan or other expenses which are not mandatory for the operation of the property. You also would like your NOI to be as high as possible to maximize the property value when we talk in just a little bit longer about cap rate and we discuss the NOI, it'll come into play there. So I understand, like, if you have a loan, obviously it's mandatory. You need to pay that bill. But it's not mandatory that every person who buys a piece of real estate has a loan. So
Okay.
it is considered a non-operating expense. It doesn't have to do with operating the property. Just like another example, like to exaggerate, would be if you had a management style that you decided it was a requirement that you or someone was going to drive to a property, which is an hour away, every single day and put their eyes on the property. There's an expense associated with that. I mean, we're going to be paying mileage, we're going to be paying time, we might have a vehicle. That's not mandatory to the next person who buys the property. But if you're, just something about you, you can't stand not driving over there every day, that could be an expense. You could write that off, but it's not mandatory. So we don't want to include it in our NOI or penalize our NOI by paying that expense.
Gotcha.
The next person would not have that same expense, or might not, is really kind of what I'm going at there.
So the operating expenses need to be complete, but we want to make sure that they're like a normal set of bills for who owns the property and pay, not optional ones, right? So in the NOI, we're including things that a general most people will be paying on.
That's right. And there's also, I mean, there's absolutely some standard things that will put in there, but and we'll talk about the specific list in just a moment. But yes, I mean, you want to standardize it, and you want to use things that are typical and required, and not luxury items that you might be trying to expense when you're developing that. Yeah. And so on that there, I mean, I think that basically, to move into NOI, what we need to do is we need to know how to calculate the two components of it, which are effective rental income and operating expenses. We just talked a little bit about operating expenses, but the effective rental income is the first thing you need to calculate to be able to calculate your NOI.
So, what it sounds like there is with the effective rental income, I would like for you to touch on that. What is that? Because why would you not just call it income or rental income? What makes it effective rental income?
That's a good question. So, effective is, and again, we're talking about an analysis here. So, we have to put things into buckets, and we have to use words that are standardized so that all of us know what bucket we're putting something into. So, the effective rental income is what you would be receiving or what you'd be expecting to receive after vacancy or an allowance for vacancy. It's pretty simple. So if we're going to rent a property out for $1,000 a month, our gross potential income, so the potential here is how much we could be making, would be 1,000 times 12, or $12,000 a year. And then let's just say we assumed it was going to be vacant for 1 month per year. So we would take off $1,000 for vacancy, and we would be left with our effective rental income, our actual rental income for the purposes of the analysis, of $11,000.
So, gross potential income can vary from year to year. So, if you have like a multi year tenant and you don't have to account for any vacancy, then you wouldn't have to take that off. So, gross potential income can vary from year to year.
Gr- Both gross and effective, actually.
Okay.
To go a little further on your multi-year tenancy, let's also assume that we have annual rental increases. So let's say we have a 3-year tenant,
Ah,
and perhaps year one is 1,000, year two is 1,100, and year three is 1,200. Like, just keep it easy. So in year one, maybe we had like 2 months of vacancy. So it would be 12,000 minus 2,000 would be $10,000. In year two, was it $13,200 would be our gross potential income, which is 11,000 times 12, but we have no vacancy. So our effective rental income in year two would be $13,200. And then in year three, we had another rental increase. We went up to $1,200 a month. So we have $14,400 of gross and effective income because we had no vacancy. So now that we know what our effective rental income is, let's talk about the other part of the NOI calculation: operating expenses. Operating expenses, as we mentioned, consist of expenses which are mandatory to the operation of the property. So, a list of things which basically are going to be mandatory are property management, leasing commissions, property maintenance, property tax, property insurance. All of those things, you cannot have a property without having those things. Also, if you are providing utilities to a property, then those would be an operating expense as well. A few minutes ago, we talked about the loan payment, and the loan payment is not mandatory, so that's why it's not listed above as an operating expense.
sure. So, then operating expenses, from what it sounds like, can vary from person to person depending on what they're wanting to include in the property, because not everyone uses a property manager. Property management fees may vary from person to person. So, is it possible that, for what I'm saying there, that it can vary from person to person on what the operating expenses are? Is that why these are not mandatory parts of the effective rental income?
Yeah. So I would say the operating expenses, when they vary from person to person, they're still Mandatory or not, I'm having a hard time putting that into the right bucket. So let's just throw things that are entirely unmandatory out the window. They're
Hmm.
still an expense. You'd still write them off on your taxes. So the interest on a loan, the hyper frequent property visits that we talked about, those could still be expenses. An example of something perhaps that a person might do is self manage. So
Sure.
let's say that we were assuming on our $1,000 a month property that we were going to hire a manager and spend $100 a month. But this other person is not. So their operating expenses are going to be less, and their NOI is going to be higher. Now here's the thing. The property value is a multiple or is a formula when we calculate cap rate and property value based on NOI. If you were to go to sell a property and say, hey, here's my property, here's all the expenses, and you don't list a property management expense, you are underestimating or understating your operating expenses. And you are therefore not painting a full picture of what it's going to cost to operate that property. Consequently, or conversely, if the buyer was to look at a property and say, hey, I'm going to self manage this thing, so my operating expenses are not going to be as high, they might wind up overpaying for a property. So, I may have said earlier you need to properly develop your operating expenses. One of the ways to properly develop them is to include like plug numbers or some value of services that you might be doing yourself, just to be sure that maybe you decide to stop managing it. You need to hire somebody. Let's be sure that we know what that was going to cost. You can have two sets of numbers even. You could be like, hey, this is how I'm going to analyze the property. This is how I'm going to market the property. And then over here, I'm going to take off these things I'm going to do by myself, and I'm going to figure out what's really going to go into my pocket. But they definitely need to be considered.
Okay, that makes a lot of sense. So now that we have a good understanding of the effective rental income and our operating expenses, let's get into some math. What do we do to calculate that NOI?
So that's actually the easy part. The NOI is in this. The math gets harder, but the really easy part is NOI is just the effective rental income minus the operating expenses. So in the example we had earlier, we wound up with $11,000 of effective rental income. Let's just say that our operating expenses were $6,000. So you would just say $11,000 minus $6,000 is $5,000 of NOI.
Okay. So that is the easy part. I mean, that is a simple math equation that my 8-year-old could do for us.
Yeah.
But I can imagine that it's going to get a little bit more complicated. What do we do now that we know once the NOI is? What do we do with this information?
Yeah. So we're going to use it to determine the property value.
Okay, so you use the NOI to determine the value of a property. Can you have a negative NOI? And if you do, does that mean that your house is worth nothing? Like how does that happen? Is that possible?
Yeah. So, I mean, I suppose you could definitely have negative NOI. Um, you just need to know going into the property if there's something maybe other than cash flow that was driving your decision to buy the property. Maybe the property is going to appreciate a whole lot, or maybe you believe that while the rent right now won't cover the expenses, you feel that after the Whole Foods is done being constructed, that you can triple the rent or something like that. It wouldn't make it be worthless. It would just mean that you maybe, like, let's use the example where we have $11,000 of effective rental income.
Hmm.
But let's say that we had $15,000 of operating expenses. So we're going to lose $4,000. You just need to take that into consideration. If you're going to buy this property for a couple of $100,000 or $100,000 or whatever it is, you need to know that, hey, in the first year, you've also got to write another check for the $4,000 that the thing didn't make.
Sure.
Yeah, so it's not impossible to have negative NOI. I've definitely seen it happen. I've been involved in it for various reasons. But ordinarily, if a property has negative NOI, you're going to be looking for other reasons to buy it besides the cap rate that it generates.
And so just want to touch back on something that you said there before we move on. And when you're saying that the NOI determines the value of the property, does that mean the value of what I'm going to earn from the property? Does that mean the value of what I can sell it for? What do you mean by the NOI determines the value of the property?
So the NOI in relation to the cap rate that we're using for this property is how we determine what the market value is. When you're using the
Gotcha.
income approach. And that's actually pretty pertinent there because you just mentioned, well, does it have no value if it has negative NOI? If you're using the income approach, yeah, it might have no value. But if you're using the replacement approach or highest and best use or something like that, you may find that it has value somewhere else, and we're just going to ignore the cap rate. So I think it, you know, we're not trying to ignore cap rates, especially not on this
Hmm.
episode of this podcast because we want to talk about them. But we had to first get through NOI, and you've asked an excellent question about, what happens if your NOI is negative. So that's the answer. That's what happens if your NOI
Okay.
is negative.
So then that's a great transition into where we're going. What is a cap rate? Why does everybody talk about cap rates? Because in my experience, whenever I've worked with single family residential properties, I've been told that why even look at a cap rate for a single family property? That's something for multi, that's something for commercial. So I'm curious to hear from you. What is the cap rate? And
Yeah.
why is it so important? And how do we look at that from a single family approach?
I love it. I love it. So first of all, everybody talks about cap rates because it's a cool word. So that's step one. Cap rate stands for capitalization rate. It is the rate that your capital is realized or returned to you in the first year of operation. Cap rate is not an acronym, and when you put it in writing, if it was used in a sentence, it would just be all lowercase. It does not have periods after it, and it is not all caps. I would love if anyone is listening to this who works for Marcus and Millichap, if you could explain to me why in all of your marketing material it is all caps for cap rate, because it is not an acronym. It is not cash on cash. It is not IRR. It is not ROE. Somebody call me and tell me why it is in all caps. But
It may just be like an emphasis. They want to say cap
it
rate.
must be. It must be. Well, yeah, they must be trying to do that, but I'm here to tell you you're wrong. Um, but so the cap rate is the relationship between property value and NOI expressed as a percentage. So, for example, if a property generates $10,000 of net operating income and the market says that it is worth a 10% cap rate, you would take the $10,000 of NOI, divide it by 10%, and you would determine that the property is worth $100,000.
Those are some very specific numbers that you use there. And so you used 10%. That's what we were dividing by. Is that a general number that you picked to throw out there? Is that what it is divided by? But how did you get to 10%?
So, first of all, I can do math to 10% in my head really quickly. Um, but second of all, as you participate in a market, you start to learn what people are paying. It could simply be that you receive a lot of email blasts and you skim that email blast to see what cap rate people are advertising properties for. It could be that you're analyzing a lot of properties and you're determining what the cap rate is, and you start to realize, like, hey, this type of property in my area is currently trading for an 8% cap rate, and that type of property is currently trading for a 10% cap rate. It also may be that, like, an investor says to you, hey, listen, I know that I can invest in the stock market and earn a 7% return. And to them, that's not risky to them. They feel
Mhm.
very comfortable doing that. But they are interested in buying a duplex. However, they consider that more risky than the stock market investment. So for them to be willing to do that, they would need a higher return, and maybe 10% just becomes their number.
Gotcha. Okay. So if something is more risky, it has a higher cap rate. Like, is that how those numbers correlate together?
Yeah, generally yes. And also the cap rate has an inverse relationship to the value. And so what I mean by that is as the cap rate goes up, the property value is going to go down. And as the cap rate goes down, the property value is going to go up.
Okay. So is that what you mean by risky? Whenever we're talking about riskier, I understand the risk in the stock market, but if we're talking about risk for a property, are we saying risk for non-performance? Like, or we're saying the NOI is lower? What can you define for me what we're talking about risky there?
Sure. So let's do one other way of utilizing a cap rate so we could talk about the risk. So let's say that a property is advertised for $100,000, and one investor says, "Well, I have to have at least an 8% cap rate." Well, what they're saying is that thing better generate $8,000 in the first year. What they're saying is that if I've got to pay $100,000 for this property, it better produce at least $8,000 in the first year. Cap rate only has to do with the year one. Remember, it's the rate which your capital that you laid out for
Hmm.
the property, only cash. Again, we're not talking about loans. So it has to do with how much money you spent on the property in total and how fast that money came back in the first year. Now, somebody else might look at that same $100,000 investment and they might say, well, I've got to get $10,000 for that. I think it's risky. So another person might say, well, I have to get $15,000 back. I want to get my money back even faster. So the risk there is, are we talking about a Starbucks that's on a heavily trafficked corner where we are just pretty dang confident that that rent check's going to show up probably early every month? Or are we talking about some kind of a business that, or a house that is in a poor area where the schools are like just a 1 out of 10 rating, and that a family, as soon as they move in, they might decide to move out because they don't like the area, they don't like the schools, and so we're thinking, hey, this property is a little riskier, so we better pay less cap rate, again, higher cap rate, lower
Hmm.
value, or we better get our money back faster. Does that help you understand that a little bit?
Absolutely. So, just as a curious question here, so is cap rate almost subjective, right? So, if one investor decides that the property is not super risky to them, then they would make the cap rate less.
Yeah. So yeah. Let's say we're excusing the market. Like maybe there's not 100 people lined up that have all said that they'll pay a certain amount based on a cap rate. And let's say one investor says they'll buy the property at a 10% cap rate, which makes it $100,000. And then another investor says they'll buy it at a 9% cap rate. Well, if you took that same $10,000 income stream, remember we took 10,000, divided it by
Hmm.
10%, it's worth 100,000. If you took 10,000 of NOI and divided it by 9%, because we have this other guy that's not really that nervous, he will now pay $111,000. So obviously the seller is going to sell it to the guy that's going to pay more. So whether or not they just said, "Hey, I really want to buy it. I'll pay 110 or 111," or whether they actually did the math and said 9% is okay with me. Yeah, it is a little subjective. It's a little subjective. Again, there's ways that you can look at an area. I mean, you could go analyze 100 houses and you could
Hmm.
say, okay, I have it figured out. In this neighborhood, the cap rate is 6. And you could know, like, if I get less than 6, I'm overpaying, or I could have bought
Hmm.
a different house that would generate 6. Or you could be looking at email blasts, and other things like that. So that it's somewhat subjective, but there is documentation in the market that you can start to absorb and read and study, and you'll start to figure out what current market cap rates are.
Okay. So in both of those cases that you talked about at the beginning there, that example of two people looking at a property, one of them's going to pay $111,000. Their NOI was the same, but one buyer would accept a little bit lower return on that stream of their NOI and figured that they could pay more.
Yeah, that's exactly right. So, and basically, maybe they could have been basing it off of their own personal minimum cap rate, and they decided that they'll
Hmm.
pay more. Um, there's lots of people's personal motivations that come into real estate that we can't always know. What I can tell you is if you said to me, Morgan, I'm going to sell you this property for $200,000 and it has $10,000 of net operating income, I would say, okay, that is a 5% cap rate. Like I know
Hmm.
that. And if it had a $40,000 of NOI, then that would be a 20% cap rate. Like we know that
Right.
also. But basically, in some cases, it's just really up to the buyer on what they're willing to do.
Interesting. So, whenever we're talking about the cap rate, like I said, in my years of experience in the residential real estate and residential property management, I haven't heard cap rate be thrown around a lot. This seems like something that is like the sophisticated investor is looking at this. And so, that's why I've heard over and over again, this isn't relevant in residential real estate. But it seems like it's something that should be. It's something that should be talked about. So I'm curious, Morgan, from your point of view and your experience, cap rates, are they really relevant in residential real estate? Do I need to be looking at the cap rates whenever I'm going to purchase my residential investment property, single family residential investment property?
That's a good question, Kristen. Um, so first of all, people love to say the word. It's a fun word. Okay. They also love to talk about it. Um, it is great. I mean, cap rate's a really important thing, but the reason that it is not often used in residential real estate is that you cannot buy a house based only on the cap rate. If you called up a broker who had a listing and said, "Hey, my client wants to buy your house, but you have it listed at a 2.3% cap rate, and they will only pay a 3.5% cap rate." The broker is going to look at you like you are from Mars. And so, in residential real estate, or let's at least boil it down to 1 to 4 family residential real estate, because you
Okay.
start getting into, eight plexes and stuff like that, and it is pretty much definitely going to start to be more cap rate driven. But in the one single family, like one unit, or 1 to 4 family, cap rate is more of a byproduct than
Hmm.
something that actually determines the value of the property.
Okay. So could someone still determine whether a property meets their criteria based on cap rate, even though the property isn't being sold based on cap rate?
Yeah, yes, absolutely. And so that's where it's a really important thing to know. It's
Hmm.
a really important thing to be aware of. What's your alternative? You say I could get 7% in the market otherwise, so I want a 10. I personally have had a client. So here where we are, we're based in the Woodlands, Texas. It's north of Houston. There's a disconnect. There always has been between the purchase price of houses and the rental rate. Our rental rates just kind of lag behind the purchase prices, and we don't have high cap rates. I mean, it's not the type of area that we're in. This also would exist in areas in Colorado and in Utah and California would be way even more amplified. But it's this is not unheard of. Okay, and so I've had a client most recently came to me and said they wanted a 4% cap rate. Okay, so we searched around for houses. We used Discover, and found them houses that achieved that cap rate. But then we ran comps based on the sales price, because again, the
Mm.
MLS is not publishing cap rates. The MLS is
Right.
not saying, "Hey, the value of this house is 4.1 and the value of that one is 3.8." So we used sales comps, to be sure the price was priced appropriately and that it met our cap rate hurdle. So it was nice to know, and it was a purchase requirement, but it wasn't the thing that it became the final determination of what the seller would sell the property for or what the buyer would buy the property for.
Okay, that makes a lot of sense. Makes a lot of sense. So, typically then whenever we are analyzing our residential property, we have to take other factors into consideration other than just the cap rate. So could you touch back on that where you use the sales comps? Did the sales comps, you said it's not applicable to what the buyer would buy it for or the seller would sell it for, but it matched the cap rate? Is that what you said?
Yeah, exactly. So let me restate that a little differently. So let's just say that we found a property that was for sale for $300,000, which did achieve a 4% cap rate. Okay, so we looked at the property and we said, hey, this thing will rent out for $2,200 a month. We're going to have a little bit of vacancy. We have all of our operating expenses. But remember what I said was a 4% cap rate. So I got my
Mm-hmm.
calculator here. So I said $300,000 times 0.04. So one way that you use cap rate is you take the purchase price, multiply it by the cap rate, and you arrive at how much NOI it would be generating. So that says there that I'll be generating $12,000 of NOI at a 4% cap rate. So we used Discover, we did a search, we found this particular property, and we then said, okay, checkbox number one, it meets a 4% criteria. Checkbox number two, we did some other analysis on it, and we figured out it met our other criteria. So hey, this is a good property. We want to take a run at it. Well, then we looked around and said, okay, we know that the investment value of this property is $300,000 for us. Okay. But if all the other houses in the area are selling for 220, we're not going to go offer 300. We're still going to be sure that we're paying the right amount of money. So then we go look at sales comps and we say, well, hey, sure enough, based on the price per square foot, this property is worth $300,000. They have it listed for $300,000. We can pay $300,000 to achieve our cap rate. Off we go.
Thank you, Morgan. That was very, very clarifying because I have learned a lot so far. I really like the way that you defined cap rate. I haven't heard it defined in that way. I was given a math problem and said, "Here's how you here's how you come to the cap rate," but I didn't realize that it was the rate at which your capital is returned to you. And now I will forever look at cap rate in that way, and it makes so much more sense now whenever we're looking at a 6% cap rate or a 10% cap rate, because that is the rate at which what the purchase price of the property is
Yeah.
returned to me. Is that the right way to look at it? It's not how much money I put into it, it is the price of what I'm purchasing it for.
So if you keep your cash buyer hat on, then yes, it is how
Mhm.
much you put
Okay.
into it. So when we do cash on cash, which will be the next part of the series, we will continue to work on the concept you just described. But yeah, it's how fast the property, the money you spent on the property, how fast it returned that money, so that you could then use that to pay for the loan and so on and so forth.
Absolutely amazing, Morgan, that you broke all of that down, and I'm with you. I am understanding absolutely what we're talking about here. For the cap rate and our NOI and our effective rental income, all of those things have to come together in order for us to come out with how quickly our capital will be returned to us.
That's right. That's right. You've got it. So, yeah, I mean, I would say that if any of our listeners have any further questions on cap rate, I'd love for you to reach out to us. You can send us an email at info@discover.com, or you can find us on social media, and perhaps we could work in a more specific question into a next episode. But I think that the examples that we went over there, you said it made it very clear for you. So hopefully that clarifies it for anybody else too. And if you're looking to start to really dive into cap rate, whether it's a property you already own or a property you're looking at buying, it's relatively easy to set the formula up in Excel, or to use our system Discover and type in the address and tune up all the numbers and see how it's performing.
Yes, that is one of my favorite things about Discover is I can put in the address and it calculates the cap rate for me. I no math is involved, only
No math.
typing. And
And
I
and let me just speak on that real quick. I think it's I mean, I don't manually calculate cap rates very often. I can do it. The that's relatively straightforward math in my opinion, but I think it's important to understand the cap rate, to understand why it exists, what it is used for, how you apply it. it's not a requirement that you can do the math. You don't need to be a mathematician. You just need to be able to explain either to a banker that you're asking to, a loan, or to a partner that you're looking at buying a piece of real estate with, or if you're an agent working with a client, say, hey, this property achieves a 5% cap rate, and this is what that means. That's really what's more important. We don't need to have you sit down and take a test and prove that you know the three different components of a cap rate and exactly how to do the math and things like that. So, but
So
yeah, no, go ahead, Kristen.
as no yeah, as we're wrapping up this episode, I have a question for you. So we've talked a lot about, if I'm going to purchase a property, I'm looking at cap rate. Let's say that I already own a home and I am deciding to turn that property into an investment property. I'm moving out, or and I'm gonna turn it into a rental property. Is the cap rate still important for me at that point, as I already own this home, I'm not purchasing it? Do I still need to look at cap rate?
So that's a great question. I would say, yeah, I would still be looking at the cap rate of a property I already own. I'd be looking at what is the cap rate next year. I'd be
Mm,
looking at how much NOI does the property generate, and what do I want to sell it for, or what is the property worth, and what is that cap rate? Because then you're at least understanding what's going on in the market. You're understanding, hey, I own a house. It's rented out for a market rate. I'm paying market fees for commissions and management and taxes and insurance and maintenance, and it's generating this much NOI, and it's worth this much money. So the cap rate of this property is 8. Let's just say it's 8. Um,
mhm.
in that case, I would in that case, I would say, yeah, it's a nice to know, because many people who are not accidental investors or accidental landlords are looking for another opportunity.
Mhm.
So let's figure out what the cap rate is of the property you already own, or the properties you already own. And then you can use that when you're trying to figure out, hey, should it be 4? Should it be 10? Should it be 12? Well, my current property is 6.7. So if I'm buying one in the same neighborhood, we better at least be hitting that number.
Gotcha. That makes a lot of sense, Morgan. So, very, very important whenever we are looking to purchase a property. If we are in the instance where we're turning a property into an investment for the first time, we want to know what it is going to be for the next year that we'll have the property.
That's right. That's exactly right. And that's a very good practical application of cap rate. I mentioned you need to be, checking out emails and seeing what properties are offered for. Hey, you got your own property, you've got your own data. Now you know what they're worth, and you could even think to yourself, would you sell it for that much money? Would you sell your property if it was priced at a 6.8? No. Okay. Would you sell it at a 5? And so there you go. Now you know maybe what you're up against, and what you think it would really be worth, in a cap rate basis, on an income approach. And when we do the next episode here shortly, we'll go further into cash on cash return, which will involve a loan, which will assume you're not a cash buyer. We'll still talk about cap rate and how it affects cash on cash, but we're going to then go to the down payment portion of it, and how much money we're going to earn after we pay for the loan, and a couple of other things. So that'll be episode, or the second part of the series. Yeah.
Yeah, it's going to be an exciting one. So, as we're rounding this out, Morgan, any parting shots that you want to leave our listener with today?
Well, I feel like the final part there was actually really good. No, I think my only thing I want to say is, please be sure that if you're taking the time to, especially if you've gotten this far in the podcast, if you don't understand the concept, reach out. If we feel like we could explain something better for you, or if you have a question, I love talking about investment real estate. I love sharing, my knowledge and my experience in analyzing real estate with people, and we're here to help. So, also, hey, if you got a property you want us to analyze, we could do a segment on here. We could take 5 or 10 minutes. We'll call you up. We'll do a screen share, and we could even include it on the show. So, let us be a resource for you. And if you feel like there's something about cap rate that you don't fully understand after this episode, I'd love to know about it, and I want to help you.
Awesome. Thank you so much, Morgan, again, for sharing your knowledge and your experience with us. It has been absolutely a very educational and clarifying episode, even for me, having been in real estate for the last 8 years. I see things more clearly after today. It's been fantastic. Thank you so much for being able to break it down and explain these very large concepts to give us all a foundation as we continue to grow through the real estate crash course.
Well, I love it. And thanks for spending the past hour with me, Kristen, so that we can get this for other people to learn as much as you just did.
Absolutely. And as always, this episode is brought to us by the wonderful company, Morgan, that you created, Rescover. And Rescover is the tool if you are looking to analyze your properties to be able to find your cap rate or any of the other values that we're going to be talking about in this series. You can head over to www.rescover.com. And like Morgan said, reach out to us and we'd be more than happy to help you to analyze any of your properties.
Love it. Thanks, Kristen. I'll see you next time.